in charge of Grassi Franchise Services. I want to welcome everyone to our webinar, Adding Value to Your Business. Franchisees throughout the years have asked many questions on these topics. Ultimately, one, what's my business worth? Two, if I sell my business, what am I going to do with all this money? Three, with all this money, how do I direct it to next business ventures, to heirs, and so forth? And of course, lastly, how do I never, ever pay taxes? Well, we have answers for some, not all, but most are good responses to these questions. And in response to this, we put together a panel of experts from Grassi and Company, as well as outside partners, to address them. Today's panel includes Rob Conza, Executive Director of the Cypress Group at Morgan & Stanley, Lisa Ruspoli, Partner in Charge of Trust and Estates at Grassi and Company, Frank Delapi, Managing Director of Coordinating Planning Group, and Pat Raffinelli, Valuation Manager at Grassi and Company. Please note, while we conclude the webinar with questions and answers, if you'd like to submit these questions, you can type them in the bottom right-hand side of the screen. In the event that we run out of time and cannot answer all questions, we'll follow up after the webinar. Without further ado, Rob Conza will kick off today's webinar discussing financial planning.
Well, thanks a lot, James. We're very happy to be here. We're looking forward to the webinar as well as the event that's coming up. Orange Theory is a great franchise, as we all know, and we're happy to be part of it. As James said, my name is Rob Conzo. I'm Executive Director of a financial planning group we call the Cypress Group. We're part of the Grassi Life Plan Alliance, which we're pretty proud of. That is an alliance of professionals that are brought together to ultimately provide solutions for high net worth individuals and owners. Our team is made up of about 10 people. We manage about $1 billion in assets. We have 2 locations, Melville and New York City. We deal with clients all over the country. So location is not an issue. And I know with franchises, you have to be mobile and you have to be global, and we are. So we're looking forward to meeting you in the future. This slide is basically to pictorially show what financial planning is. I think financial planning is a very overused word and very misunderstood. Financial planning is not investment planning, it's not insurance planning, it's not accounting, it's not estate planning, it's all of those things combined. And how do people go about it? It seems very daunting at times. The project seems gigantic. What it really is a series of projects, when culminated together, are called financial planning. And this slide is showing the client is centric. And surrounding that client is a circle, and it says the Grassi Life Plan Alliance. I mentioned that earlier, and I want to explain it a little. The Grassi Life Plan Alliance is exactly that. It's an alliance of outside professionals who've been vetted by Grassi. They're top tier in their respective professions, and they all combine to bring in a solution to various issues of an owner's life. Like what? Estate planning, elder care planning, how to protect it from a nursing home, business succession, and everything else, investments and insurance, and making sure your assets go where they should go, mortgages. So it's not as daunting as it should be if you are hiring the right people. How to find those people is you use the Grassi Life Plan Alliance. And the nice thing about the alliance is we're very comfortable doing and working with other professionals that you have in your life. It's not a one-stop shop. We'll kind of, it's like a Chinese menu. We'll pick and choose and we'll make it whatever you need it to be. And one thing we've learned well is how to play in the sandbox well with other professionals. I think that's one of the hardest things you find when you try to general contract your own financial plan. You might find the attorney doesn't work well with the insurance person, who doesn't work well with the investment guy. It's a problem. We think we got the solution to that problem. Concerns, James mentioned some of these, and they all hit different areas of financial planning. Will I outlive my money? Do I have a succession plan? And let's talk about that. I mean, your business typically is people's biggest asset. How you monetize that business is very important. And when you ultimately do monetize that business, will that money be enough to carry you in your retirement? That is something that people whether they're a policeman, a fireman, or a major business owner, think about all the time. And there are people in this room that are going to help you with that as well as us. Market volatility in retirement, that can mean anything. That can mean real estate market volatility, investment market volatility, bond, or even your own industry. Volatility is a way of life and should be dealt with accordingly to get you where you need to be. Saving money is everything. If you don't save it, you won't have it. And you could save it through your business. You could save it outside of your business. There are right ways and wrong ways to save your money. That's something we'll get into. Insurance needs, very important. Help you move the money to where it should be, protect your assets, tax savings, and there's a specialist in the room who is an expert in that. He'll be talking to you further. As far as how do my assets pass to my heirs, well, what that really means is you want to protect it from entities that are trying to take your money. Who are they? The federal government, nursing homes, the ex-spouses of your children, or even, God forbid, your ex-spouse. So people are trying to separate you from your money, and there are people in this room that are going to talk to you about estate planning and business succession and business valuation. Together, all these people, as well as your outside professions, will put together a financial plan. We like to consider ourselves a quarterback in that scenario. We put the Grassi partner first, and then we bring in professionals with you to get it done. The next slide really is, I'm not going to get into this much because there's people in the room who will talk about it in detail. This is just to show, hey, an estate plan is one piece of a financial plan. And we have a professional get into it in much more detail later on. Strategies. Well, this is kind of simple. And I think a lot of the things we do, and I don't mean this to discredit anybody in the room, I don't think it's rocket science what we do here. I think a lot of what we do here is address the things that business owners don't have the time, the patience to get involved in. And that's what we do here. So one of the things you have to do, like in any plan, is identify what your goals are. Hey, when do you want to retire? If you do retire, how are you going to monetize your business? One thing all business owners should be thinking about is sometimes it's great to create a management group. That management group takes over your business at some point and pays you an amount over time so you get bought out and it doesn't devastate the business. Or you sell it to a competitor or whomever. But monetizing a business is big. How much will I spend in retirement? Will I buy a second house? Am I spending for college education? You got to identify the goals. How do you do that? Is you do a data gathering meeting, a very detailed data gathering meeting with my real estate, my kids' ages, how much money do I have, my assets, my business, my insurances, how much am I spending, what do I plan on spending in retirement? We always take these out till 90. So you lay out what we call, step one, a financial projection to lay out ultimately what this pot of stuff, real estate, business, investments, could grow to over time. And then if you do that, it becomes the foundation of all the other financial planning projects. We don't believe you could come up with an investment plan without laying out a financial projection. How could you? You have to understand what rate of return you're going for and all the other components that come into it. Only till you do that work, and we do that work at no charge, then we have the basis for an investment plan. We also have a good basis for insurance planning. We like to give this to an outside professional, and he'll take that information and help you with that. How about estate planning? Do you even have an estate tax concern? Well, the only way you can tell that is what is your estate going to grow to in the future, right? So we think step one of any financial plan is to do a projection. Diversifying, avoiding emotional decisions. Look, I think that's good in anything. Proper savings. We're specialists in all forms of corporate savings plan, either qualified or non-qualified. 401k, profit sharing, stacked match, new comparability, defined benefit, cash balance. These are all things that people need to understand and figure out how they fit into the financial projection. Remember, The financial projection is going to help us to figure out what you need to save. How you do that is corporate-owned plan or a non-qualified plan or many other things. So we'll get into that as well. We do believe you should use financial advice. I think it's pretty basic, but I think it works very, very well. So to summarize this, like I said, I didn't want to take too much time, but I wanted to give you an idea of what's going on, is step one, identify your planning team. What I think that typically is a hybrid between the Grassi Life Plan Alliance and the people that you have in your life already that you trust. Agree on the projects. How do you do that? You start with a data gathering. The team meets, we do an extensive data gathering, we do it over the phone for many people across the country, and we understand what projects we're putting together and why. We always do a financial projection. That's just step one. It gives us a good understanding of who you are financially. It also kind of gives us an idea of how you think and what's important to you and what's not important to you. Lay out what your goals are. We ultimately figure out what those goals are and we start laying out the projects. After you do financial projection number one, then start attacking the other projects, estate planning, insurance review, and any other thing that needs to be there. So to summarize, we would love to be that financial planning team for you. We'd love to be the first stop in a larger picture that could take a month, 6 months, or 2 years to accomplish. And we'd love to work with the Grassi Life Plan Alliance going forward to get it done. With that, I look forward to meeting, hopefully, some of you at the trade show, and I'll send it back to James.
Robert, thank you. Sorry, I just got a text from my daughter. She knows I'm doing a live webinar, so I have to put some jokes in there for her. What do you call a deer with no eyes? No idea.
What do you call a deer with no eyes?
What do you call a deer with no eyes, no legs? Still no idea. Next up is Lisa Foley, partner in charge of trust and estates at Grassi & Company.
Thank you, James. Okay, so our current federal tax system, I get to talk about death and taxes, which is my favorite topic. Our current federal tax system taxes transfers of wealth for U.S. citizens and residents on all of their assets owned worldwide. Just last week, President Trump mentioned in his discussion of tax reform that he wants to see an elimination of the estate tax. He never mentions the gift tax, and neither did the Republicans in their tax blueprint that they issued in June of last year. In his campaign proposal, Trump spoke of possible capital gains tax at death, which would be a change in the estate tax system, not an elimination. We can only plan under the current system. Planning for asset protection from creditors and divorce is just as important, if not more so, than planning for taxes. So the current tax is a cumulative tax on lifetime transfers. So if you gift away $1 million during your lifetime and you die with assets totaling $5 million, your taxable estate would be $6 million, the $1 million plus the $5 million. This would result in a tax of about $220,000, which is 37%. The top rate is 40%. In addition to the estate or gift tax, a generation skipping tax is imposed if you attempt to skip a generation and leave assets directly to your grandchildren or nieces and nephews, or someone who's 37.5 years younger than you and not related to you. So as not to be too greedy, the federal government allows for a unified credit, which equates to the exemption equivalents shown in the chart. And that applies to both estate and gift tax and generation skipping tax. What that means is you can gift and or die with assets less than $5,490,000 in 2017 and not pay an estate or gift tax. And the same exclusion applies to GST. It's going up to $5.6 million in 2018. If you do exceed that exemption during lifetime by making taxable gifts, you'll pay a gift tax at the same rate. There are annual exclusions of $14,000 per person. So you can gift up to $14,000 per person per year and not have to file a gift tax return, assuming you have not taken any valuation discounts. And that's going up to $15,000 in 2018. If the taxpayers are married, they can gift split, which results in annual exclusions of $28,000 per donee, or $30,000 in 2018. Once you go over that $14,000 or $15,000, you eat into your lifetime exemption of the $5 million and change. One other point worth mentioning is that transfers for medical or educational purposes are not considered gifts, and they should be made directly to the medical or educational institution. Payments to 529 education plans are not considered educational, and therefore they are taxable gifts. So to help understand what this all means, I laid out a simple example. John and Mary are both 50 years old. They have assets totaling $9,300,000. So you say that's under the combined exclusion. Between the two of them for 2017, that's the $5,490,000 times 2 is $10,980,000. For federal estate taxes only, the unused exclusion of the first spouse to die is carried to the second spouse, and that's called portability. So let's say John and Mary do nothing, and they both have wills that leave everything to each other. They do no gifting, they set up no trusts, either during lifetime or through their wills. The life expectancy tables, according to the IRS, say that they're supposed to live 37.3 years. If the assets grow at a rate of 3%, and the estate tax exclusion keeps going up at a rate of 2% a year, then when the second one dies, assuming they both die in the same year, the estate tax would be $1,917,628. Now that seems like a low number compared to their total estate, but it assumes that they both die in the same year when the lifetime exclusion keeps going up. But what if John dies in next year, 2018, and the exclusion is only $5,006,000? The assets would continue to grow in Mary's estate, and the estate tax would be projected to be $4 million and change. At a 5% growth rate, if the assets grow at a rate of 5% a year, and they both die in the same year, the estate tax would be $12,009,000. If John died next year at a 5% growth rate, the tax would be $15 million and change. The numbers start to get scary. Add to that the potential state estate tax. I'm hoping you can read this chart. I tried to put it into 2 slides, but it basically lays out by state what states have estate tax, what states have generation skipping tax, gift tax, and inheritance tax. So for Connecticut, for example, Connecticut has both an estate and a gift tax with a top rate of 12%. Hawaii has a top rate of 15.7. Illinois' top rate is 16%. Maryland's top rate is 10%. New Jersey repealed its estate tax in 2018, but it still has an inheritance tax with a top rate of 16%. New York's top rate is 16%, and Vermont is 16%. But every state has different rules on their lifetime exemption. There are very simple planning methods with just annual gifting below the per person exclusions, the $14,000 or the $15,000 next year. So let's go back to that John and Mary example. Remember, John and Mary had 2 kids. They can gift $28,000 per year per kid with no effect to their lifetime exemption. If they did that for 34 years, that would equal $1.9 million in total gifts. Assuming there was no growth in their assets, that would save them about $761,000 in estate taxes. But look what happens when you add in a growth factor of 3%. Those assets that were gifted at the end of 34 years are valued at $3.2 million. So you effectively removed $1.9 million in assets that grew to $3.2 million had you died holding them. The estate tax savings on the $3.2 million becomes $1.293 million. There are more sophisticated methods where properties are transferred taking advantage of valuation discounts, which Pat Raffinelli will discuss. There are some very aggressive methods. Some methods are tried and true and have passed the IRS muster test. Others are out there being used but are continually attacked by the IRS. And they all have some very fancy acronyms. CUPERT, for example, is a qualified personal residence trust. You can transfer a principal residence or a vacation home into a CUPERT. It has a stated term, say 5 or 10 years, for example. At the end of the term, the residence is out of your hands and gifted, either directly or in trust for beneficiaries. The value of the gift into the CUPERT is discounted because it's not truly a gift until the end of the term. The longer the term, the larger the discount. However, if the grantor dies before the end of the term, the resident is pulled back into their taxable estate. So there is a risk. GRAS, or Grantor Retained Annuity Trust, work the same way as a CUPERT, but with other assets. In a CRAT, or a Charitable Remainder Trust, assets are transferred into trust, the grantor retains an annuity payment, and down the road, the remainder is transferred to charity. This will remove the assets from the grantor's estate while still providing for an income stream and allows for a charitable deduction on the grantor's personal income tax return. An IDGIT, or an intentionally defective grantor trust, is a much more complicated discussion, but a tried and true method that is very useful, especially in uncertain times, the uncertainty of the estate tax. Planning is different for everyone. There's no method that is best for all, and it is so important to discuss all issues with whomever you are doing your planning with. Collaboration with your team, as Rob previously mentioned, accountants, lawyers, wealth managers, and insurance professionals is so important. And you need to make sure you understand the process completely. I look forward, as Rob mentioned, to meeting everyone in San Diego, and I hand it back to James.
Thank you, Lisa. As we shift around internally, I do have more fun jokes for everybody. And I promise, yes, our advice is much better than my jokes. What do you call a man with no arms, no legs in front of your door? Matt. What do you call a man, no arms, no legs in the ditch? Duck. This is my 10-year-old. This is what we do all day, every day. A little window of my life. Next up is Frank Labby, from Managing Director of Coordinated Planning Group. Frank, take it away.
I guess we can now say good afternoon. I'm going to talk a little bit today about some ways of mitigating some income taxes for the owners of the franchises. And I think this is an area that everybody's going to be a little bit interested in because it sounds like anybody likes to pay a lot in income taxes. First thing, before I go into the program, one of the things we're going to talk about is a program called the Restricted Property Trust. And in order to go into that, you have to understand what restricted property is. The most common form of restricted property would be stock. If you work for a large company, sometimes executives get stock bonuses. and they're restricted. They have to stay with the company for approximately 5 to 7 years before they can sell the stock. But they do have the option today, if the stock is worth $10 a share and they get 1,000 shares, it's worth $10,000. They could pay tax on that today. And if they stay with the company 5 years and the stock goes up to $100,000, they'll be worth $100,000 in their shares of 1,000 shares. And they would pay only capital gains tax on that at some point in the future when they decide to sell the stock. So that's how restricted property works. So we're going to talk a little bit about the restricted property trust today. So let's go ahead a couple of slides here. The restricted property trust is fully selective and discriminatory. It's tax-deductible contributions by the corporation, the LLC, or the partnership. It's asset protected because it's not owned directly by the owner of the company. It's got a fixed, reasonable rate of return, and it could be used to offset any estate tax problems in the future and or any business protection issues that you might have on a key person if a death did occur. One of the important things is that you have to realize the restricted property trust is a mechanism for tax deferral, not tax avoidance. The IRS will get their money at some point in the future, because it's never a good idea to avoid taxes, because that's illegal. Let's take a look at the advantages of the restricted property trust. I originally said it's tax-deductible contributions by the company. It's asset-protected wealth accumulation within the trust. Fully selective on who can be in. It could just be for the owners or partners of the company or any key employees they want to add to it. Unlike a 401k or extended retirement plans that are covered under the IRS rules, this is accessible prior to age 59 and a half. It includes a death benefit, which will self-complete the program in the event of a premature death. It can be used to cover a buy-sell agreement, estate planning, or any key person issues that the company might have if they want to protect a key person along the way. The disadvantages. Like I said before, there's a risk of forfeiture. If the stock didn't go up to the strike price when you had the stock from a company, the stock is useless, even though you paid the income tax on the part at the beginning. So here the disadvantage is that there's a 5-year minimum commitment. Contributions have very low flexibility because there's a risk of forfeiture. Cash is not accessible while participating in the plan during that 5-year period. Must qualify for coverage by health, so it's an insurance program, so you have to be able to be insurable. And the only product that's allowed by the IRS in this program is whole life insurance, which is the funding vehicle for the program. Let's take a look at the trust. The restricted property trust has 2 pieces to it. It's got a death benefit trust on one side and a cash value trust on the other. I use the 70-30 example here because whole life insurance, 70% of your initial premiums are going into expenses of buying the insurance and paying for the death benefit. 30% of the money is goes into a cash account or a reserve account. So the trust is in 2 pieces, death benefit on one side, cash reserve built up on the other side. The RPT holds the policy death benefit on the death benefit side of the trust, and you have your named beneficiary. So if premature death occurs prior to completing the 5 years, your beneficiary would receive an income tax-free death benefit from the trust. The cash value portion during that 5-year period is held on the cash value side of the trust. You have to name, when I talked about forfeiture before, you have to name a charity. If you default on the premium payments for the first 5 years, then the cash value trust would pay the cash buildup in that trust to a charity of your choice. That's your forfeiture. Let's look at a 50-year-old in good health. Contributes $100,000 annually. The corporation receives 100% tax deduction under Section 162 and 83H of the tax code. Here's your 70-30. 70% is currently non-taxable because it's a portion of the deduction. The employee is going to pick up 30% as income during that year that he makes the 83B election. let's take a look as we go forward. $1 million of taxable income into the plan over a 10-year period, $100,000 a year. The tax rate during participation is approximately 17.2% versus 50% because you're deferring tax on 70% of the contributions. The accumulated cash value at the end of a 10-year period would be $1,064,000 and would have a death benefit to your beneficiary of $4.3 million. So here's how it works. On the right-hand side, we have the corporation making a $100,000 contribution, fully tax deductible, to the restricted property trust. The employee is going to pick up $30,000 of income and pay tax on that under an 83B election each year. The employee at some point is going to take the policy out of the trust at the end of the 5 or 10-year period. And if a death occurs, his named beneficiary will always have a $3.3 million death benefit going forward. It's currently at the end of 10 years, 4.3. We reduce it when we take it out of the trust to 3.3 million. And when we sit down, if we sit down together, I'll show you why the reduction is there. It gets into a little complicated to do over the phone. So 10-year result, $1 million in accumulated value, $4.3 million death benefit while in the trust, $700,000 of net tax deductions over that period of time. When it comes out of the trust, we're going to have income tax-free disbursements to the employee for a retirement benefit. It's an average of an 8% equivalent tax return over the period of time. It's basically like the risk of a corporate bond because it's usually A-rated companies that we're using or A-plus rated companies. The return is net of insurance costs and it's based on current dividend rates of the insurance carrier. So how does this work? And who can get into the program? Well, if we look at the chart ahead, basically the business owner or partner or a managing partner of an LLC, that's the first step. You need one of those entities. If that's yes, we move over to long-term horizon. Can you do this for 5 or 10 years? If that's yes, the ability to defer at least $50,000 a year for a long-term commitment, because that's the minimum in the program. So if that's a yes, we go down, and if you're looking for a fixed rate of return of approximately 8% annually, if you're insurable, medically insurable, and willing to invest in resources, have a CPA review of the program and agree that this works for you, then you meet the criteria and we can continue a conversation. If at any point there's a no, you do not have the ability to get into the program at that point. I'm available for any questions. I'm looking forward to meeting you guys out in California. Thank you.
Frank, thank you. Appreciate it. Last but not least up was Pat Raffinelli. Take your time, Pat. I got more jokes, I promise. I got two more, and that's it. What do you call a man with no arms, no legs, and a pile of leaves? Russell. Really? What do you call a man with no arms, no legs, hanging on your wall? Art? Oh, my God. Last but not least is Pat Raffinelli, manager over at Grassi & Company. If you look, the man has more initials than anyone has ever seen after his name, and yes, they are legit. My daughter did not type away. Pat, take it from here, please.
Thank you, James, and good afternoon, everybody. Today, we're briefly going to discuss a question that I'm sure has crossed most of our minds at some point in time, and that's what is our business worth? We've spent years building up the business, spent time, money, energy, and now we're at the point where we need to make some sort of decision. Do we want to potentially gift it? Do we want to sell it? Do we want to invest more money into it, continue to grow it? And the first thing we need to understand is, what is it worth? And this is a difficult question to answer sometimes. And the reason being, we value the business, we tell the owner what it's worth, and sometimes it's not what they expect to hear. And they spent all these years building it up, and it's worth much less than they thought it was going to be worth. So we'll address some of those things. So in its simplest form, what is a business valuation? It's a process and a set of procedures used to estimate the economic value of an owner's interest in the business. So what does that mean? We go in, we look at your financial information, we analyze it, we discuss the future with you, and we apply the valuation procedure methods to arrive at the value. This becomes your value of the business, or one could look at it as your starting point in negotiation. The value is the value to a hypothetical buyer, hypothetical seller, under a perfect situation. So sometimes people say, you told me my business was worth $10 million, and I was able to go to the open market and get $15 million, or nobody was willing to pay me more than $6 million for it. And that's because there's a lot of factors that come into it, and it's really, at the end of the day, this is the value of your business, but what you're going to receive for it, or what you're going to accept to receive for it, is really what in your mind it's worth, and what somebody is really willing to pay for it at this point in time. One of the other things that we need to look at, especially when we're dealing with franchises, is the intangible assets. It's very easy to value the tangible piece of it. What is, the fixed assets? What are the revenues? What are the income stream? But what about the trademarks or the trade names, or if you have any copyrights that come in to the franchise? We need to look at that. We need to understand that and work with you in order to apply a value to that, which could help increase the overall value of your business. So who needs a valuation? Buying and selling is a very common one. If you're looking to enter into the Orange Theory franchise, or you're looking to exit from the franchise, you would need to know what it's worth, so you know that you're either receiving the appropriate amount, or you're not paying more than you could expect to receive over the years of your time in the franchise. If you're looking to gift it to a second generation, your kids, to remove it from your estate, you would need a valuation. If unfortunately you pass away and you still have the business attached to your name, we would need to value it for purposes of the estate. Financial planning, we would work very closely with James and his team to help you maximize the amount that you can potentially get for the business at the point in time of the sale, or to help you lower it at the point in time of the gift. Any type of litigation, if you're going through a sale dissolution or a matrimonial action, you would need the value for purposes of the courts to help negotiate a reasonable, fair value. Ultimately, at the end of the day, our goal is to come up with the value that's going to help maximize what you're going to put in your pocket at the end of the day, whether that means paying less in taxes, getting more when you sell it, paying less in a litigation or a dissolution. So what are the types of services we could offer when we talk about valuations? We could do a full-blown valuation and come up with a concluded or an opinion value. That's the highest level that one could receive. The next is a calculation of value or an estimation of value. And that's where we're going to go in and we're going to do limited procedures. We're going to look at one of the approaches rather than all three of the approaches and come up with a reasonable value for your business, but wouldn't be the concluded or opinion of value, because we wouldn't have looked at all approaches, all methods, and all outside factors. The final one is the mechanical computation, and that really is more or less just a rules of thumb. We're not going to apply any analytics to your financials. We're not going to look at forecasts or projections. We're going to simply determine what a reasonable metric is and apply it to your business. This will give you a good starting point to know what your business is worth, but it is outside of the valuation services, and it's not officially called a valuation. So that brings us to the levels of deliverables. One question people always ask is, what am I going to get for, the product? I spent, the money. You did the analytics. What am I going to get? What am I going to be able to use? So if we do a full-blown valuation, and this is typically used in estate and trust matters or any matter going to the IRS, you would typically need the full-blown valuation in the detailed valuation report, to meet their requirements, especially under the gifting when we're dealing with the adequate disclosure rules. If you were outside of the gifted or estate realm and you wanted a full-blown valuation, whether it be for a litigation matter or you're looking to buy or sell the business and you needed a report to produce, or a banking required it for a financial reason, you have the summary report, which is going to give you that concluded value, that opinion of value, and a much shorter report just to let the reader know what was done. And then you have the oral report where we just sit down and discuss the value with you. You would get a one-page memo indicating such. Again, under the calculation of value, which is that estimation of value, we could provide you with either a written report or an oral report. This is typically used in financial planning, negotiation. If you want to see what the estimation of your business is worth before you ultimately decide what avenue you're going to take, you could save some money by doing the calculation of value, and we could roll that piece of that into the valuation at some point. And then under the mechanical computation, you would just get a memo. Again, that's outside of the realms of the valuation services, but if you wanted a very rough back of the envelope estimation, that's what we would do it under. The two big things that we talk about when we talk about valuations is fair market value and fair value. We spent a decent amount of time discussing fair market value. That's what it's worth to the hypothetical buyer, hypothetical seller. You see that mostly in estate and trust, gift tax, a lot of times in buy and sell. The fair value is a little more unique. That we see in a shareholder solution in a matrimonial type of engagement. The fair value, there is no particular definition. It's driven state by state. So we have nuances when we're talking about common law states or states that have unique formulas within how one applies. So Lisa was talking about discounts. Under fair market value, we would take discounts for lack of marketability, lack of control, if applicable. Under fair value, and that's the reason why it's not used in the estate and gifts arena, the discounts that are applied are determined on whether or not the courts of the state have allowed it and what the state dictates. So thank you very much for your time today. I look forward to seeing everybody at the conference, and I'm going to turn it back over to James.
Thank you. I really appreciate it. So you've heard about panel experts speak. We're going to open up for some live questions. Any question that we cannot get to today, we'll definitely respond back with an email. Please note that we will have an email go out with a calendar, so you can have one-on-one time with the list of experts that will be attending at the conference. I do realize there are some individuals that are on the webinar that are not part of this franchise. If you would like to have a poll or follow up afterwards, please email me privately, and we can always set something up. With that being said, so one of the questions came in is for Lisa, as far as, do we need a state if there's, do we need to have an estate plan if there's anything under a $5 million threshold? See if we can.
You always need a plan, like everyone, I think everyone mentioned, for creditor protection, protection from divorce, just general asset protection. If you don't have a will, your assets get passed according to state law, which is may not be what you'd like, the way that you'd like it to go. So, for example, in New York, if you don't have a will, the first $50,000 goes to your spouse if you're married, and then 50% goes between your spouse and your kids. So that may not be what you'd like to happen. Some assets to go to your kids while your spouse is still alive. So it's important to do planning for non-tax reasons.
Excellent, thank you. One of the next questions that came in is for Frank. Frank, is there an annual contribution limit? Maybe you can just, does the restricted property trust have a death benefit? Maybe you can just respond to two of those questions.
Since the trust is funded with life insurance, it does have a death benefit. That death benefit can be used for your personal beneficiaries, which could be the business, it could be a personal family member, or it could be an ILIT for estate planning purposes. And the minimum contributions, as I said before, to start the trust would be $50,000 annually from the corporation as a deduction.
Excellent. Thank you. Next question we have is for Pat. Pat,
The question is, how is the pricing determined for figuring out a total valuation?
So the value is determined based on the service that you would need. So if we're talking about a full-blown valuation, a calculation of value, do you need a full detailed report, a summary report, an oral report? So depending on the factors of what you're looking to do and the ultimate end product, we would discuss what the value would be at that point.
next question actually came in for Frank. Is a restricted property trust a form of deferred compensation?
No, it's not a form of deferred compensation. Deferred compensation would not allow for a current deduction with the company, and it would be the employee's personal money that would be being deferred. This is a deferral by the court.
Excellent. One question came in for Lisa. For when you do the estate planning, is it important to have all parties available at that time, husband, spouse, as far as knowing what things are directed, or what do you advise?
It's good to have your whole family with you, just so you have good communication. There was an incident where the person had two kids. One kid was a wealthy child, and the other child was not. And the father assumed that everything should go to the non-wealthy child, thinking that the wealthy child didn't care. But once they found out, I mean, there's emotion involved. So it's important to talk to everyone and have everyone present and have everyone aware of what your plan should be.
Excellent. Next question is for Frank. Is the RPT a qualified plan?
The RPT is not a qualified plan. It allows for discrimination, and it's governed under other tax codes through the IRS.
Excellent. Question for Robert. Robert, when doing the financial planning analysis, you had mentioned coming up with a cash flow or a study. It's not just for the business. We're talking about a life cash flow plan. Is that correct?
Yeah, that's a great question. What we're trying to understand is, what does your life look like from a financial perspective? And when you lay out a cash flow, you could call it cash flow, you could call it a financial projection. A way to think about it is, if you looked at the things that you own, your real estate, your investments, your business, and that pot of money and assets grew in the future, what would that pot of money and assets look like in the future if you started drawing on them to live or to buy things, and will it last for your full retirement?
Excellent. I have a question for Frank. What types of entities are able to actually utilize an RPT?
To utilize the RPT, you need to be either a C corporation, an S corp, an LLC, or a partnership. Sole proprietors are not able to use the RPT under the IRS codes.
Excellent.
What is an estimated price range for fair market valuation, calculation, and mechanical computation?
Again, as discussed before, there is no typical range that we charge for the service. It depends on the ultimate need, the use, the report level that you want, and the financial information of the company. So we would have to sit down and discuss that. My contact information is on the slide, so if you wanted to speak to me before the conference, please reach out to me. Otherwise, I will be at the conference, and I look forward to discussing that further with you there.
Excellent. Next question we have is for Frank. Frank, you're a busy man. Can the RPT be set up in favor of the owners and key employees, or is it just owners?
The RPT can be set up for the owners of the company or any key personnel or executives that they would like to include in the program.
Great. We do have a question for Rob. Rob, what if I have my own private attorney and that I would like to use for the financial plan?
you could use anyone that you want as a professional. Like I said earlier, we will work with anyone that you want and coordinate those efforts with those professionals to ultimately get whatever project in the planning done. So we'll work with anyone.
Excellent.
And one other, will you send out a recap of today's webinar?
Yes.
Yes.
So to everyone that's on the call, we'll send out an email that actually recaps the webinar. In addition, we're trying to answer some of the easier questions that don't require us to go into too much detail or into one particular situation for one person. We're going to keep up the questions as they throughout for another 10 minutes or so. Anything else, please send over. We'll definitely try to respond as quickly as possible. Ultimately, we're looking forward to see everyone at the conference. There we can dive in a little bit deeper. As we said before, we'll send out a scheduler. That schedule will actually have each individual listed. You can set time aside so you can get more, take a deeper dive individually into your own particular situations. And then from there, they can actually, if you put in the scheduler, there are comments. So the more information you put in, the more prepared we'll be. And we can come down with more information that's particular to your own situations. With that, is there any other questions? No, queued up. We're going to end the conference. I appreciate everyone taking the time to listen. We look forward to seeing everybody soon. Thank you so much.